guy in a 2024 Chevy lot looks at the trade-in line on his old SUV. The truck he's eyeing is $48,000. His old SUV, the one he financed 3 years ago, is worth $19,000. He still owes $32,000 on it. The dealer doesn't blink. He just rolls the $13,000 of negative equity into the new loan, stretches the term to 84 months, and the buyer drives off owing $61,000 on a truck he just paid $48,000 for. He's underwater on day one, and he's not the exception. Per Edmunds, in the fourth quarter of 2024, almost 1 in 4 new car trade-ins came with a loan balance bigger than the car was worth. That's not a financing arrangement. That's a subprime mortgage with a steering wheel. Most people remember 2008 as a housing story. Mortgage brokers selling people loans they couldn't afford, lenders bundling those loans into bonds, the bonds blowing up. The auto industry watched all of that, took notes, and quietly rebuilt the same pipeline. The protagonist of this story isn't the buyer. It's the dealer's finance manager, and the guy in the side office who actually decides what your monthly payment is going to be. His incentives are not your incentives. When the buyer says, "I can afford $400 a month," the finance manager doesn't ask, "What's the loan?" He asks, "How long do I need to stretch this thing to land at $400? 60 months won't fit. 72 won't fit. 84 months will. So 84 months it is. This is the catalyst, not the price of the truck. The choice to solve a payment problem by selling time. Per Edmunds again, same Q4 2024 data, about 41% of buyers with negative equity rolled it into a loan of 84 months or longer. The average underwater amount in Q3 was $6,458. That's not a rounding error. That's a used SUV's down payment, baked silently into a new truck's note. Here's the part nobody tells you. Cars depreciate fastest in the first 3 years. A new vehicle loses roughly 20% the day you drive it off the lot, and 40 to 50% within 5. An 84-month loan keeps you paying long past the point the car is worth what you owe. And during the entire stretch where it isn't, you can't sell, can't trade, can't refinance without writing a check. You are financially locked in. This is what the industry calls trade cycle management. That's the polite phrase. The honest phrase is, we engineered a customer who has to come back. And come back they do. Lucky Lopez, a Las Vegas dealer who flips repos for the banks, has been telling anybody who'll listen that the cars he's seeing repossessed in 2024 are mostly 11 months old. 11. Not 5 years in, not 3. 11 months. The buyer signed in spring, missed payments by winter, and the bank yanked the keys before the second oil change. The lender doesn't care, by the way. The lender already sold the loan. Auto loans get bundled into bonds, auto loan-backed securities, and shipped off to pension funds and insurance companies hunting yield. 2007 called. It wants its business model back. So who actually pays? The dealer booked his margin the day the buyer signed. Markup on the truck, kickback from the lender for steering the customer into a longer term, profit on the F&I products bolted onto the contract. The lender booked its origination fee. The manufacturer booked the wholesale sale to the dealer. 3 counterparties already paid, walking away with the money before the first payment is due. The buyer, of course, owns nothing. He owns a depreciating asset he can't sell, a payment that runs longer than most marriages, and a credit hit waiting at month 11. Now, before you say, "But he chose this," yes, he did. Sort of. He chose between a payment he could swallow and a price he couldn't. The dealer chose the math that made those two things the same number. The finance manager chose to extend the term until the lie stopped being obvious. Choice is doing a lot of work in that sentence. Here's what's actually different about a subprime mortgage. In 2008, when the bond market figured out the loans inside the bonds were going bad, the price of the bonds collapsed. That collapse fed back into the housing market, prices fell, and the entire stack unwound at once. Auto loans don't work that way, yet. The cars get repoed one at a time. The bonds keep paying. The buyer's credit takes the hit alone. There's no national headline. There's just Lucky Lopez in Las Vegas, watching a parking lot fill up with 11-month-old SUVs. So if you're looking at an 84-month note, 3 things change the math. Don't roll negative equity into a new loan. Pay it off, or keep the old car until the balance comes back to even. Don't let the finance manager solve the affordability problem with time, and know that the dealer, the lender, and the manufacturer have all booked their profit before you've made a single payment. The buyer's the only one who owns the depreciation. The buyer's the only one without a working car at the end. The book has already won, and you, on the other hand, are still paying.